Hi, and welcome to another episode of Nursing Your Way to Wealth, where a mental health nurse and an accountant talk about wealth creation, personal development, and financial independence in the UK to help you live the life you deserve.
Hi, everybody, and welcome back. Hopefully, everybody's doing well and is looking forward to another episode. This episode today is going to be focused on uh, talking everything dividends. So, what they are, why you get paid them, how you can invest them, and kind of going about how you would actually invest with purposes trying to find dividend income. But before we go into some of that detail, Alex, welcome again. And yeah, is there anything that you've learned or want to share with us for that you've learned over the past week or done over the past week?
Yeah, sure. And yeah, good job on the intro. So I think we're going to try and we'll make a bit of an effort to kind of do podcast episodes in sections. So we're going to have like a short intro bit about anything we did or learned this in the following week. We'll have the main body of the show, which today is on dividend investing. We'll play a quick game of reasonable or ridiculous, and then we're going to add a short summary as well. In terms of what I've done and what I've learned this week, I think I've really learned the power and I've felt the relief of having like good financial behaviors. So on Tuesday, which is actually yesterday for us, Tuesday morning, my car made a humongous booming sound as I was driving into work, and I had to limp it into the car park. Um, and I thought I'd burst a tire. I looked at all my tires. I didn't do anything. It sounded a bit like a jet engine when I was going kind of really slowly along. Um, Not in my wheelhouse to fix at all. Like I'm dressed for work. I'm not dressed for any mechanics or whatsoever. So I ran it past a friend of mine who is mechanically minded. He suggested get it recovered back home and he would have a look at it for me. Rang my breakdown cover, paid them £30 excess, I think. And then one of the kind of recovery guys comes on one of these humongous towing trucks. He has a quick look at it. He spends kind of 20 minutes reattaching a hose and just kind of explaining to me what happened. And I was on the way. And I drove myself home. But just having that little bit of insurance, knowing that you can call someone if something helps, is really, really helpful. And at the same time, if it did need a bit of extra kind of work at a garage, I do. I'm not sure if I've mentioned this before, but I have a like I make a standing order into a separate account for anything car related. So it's like MOTs, repairs, anything like in future, like replacing cars, something like that. So I had a bit of money in there. And I knew that that would probably cover whatever I needed, and it just gave me a real sense of peace around the problem that I could solve it just by applying some money or liberally applying some money, and it just removed a lot of the stress out of the situation. So it's just another really like a another reason why we follow the path that we're on, just to remove quite a lot of stress. So what could have been catastrophic if you didn't have any money spare actually was more of an inconvenience.
Yeah, that is. Yeah, I feel this exactly the same as you. I had a similar problem a few weeks ago, but yeah, it is such a nice stress reliever. And when your only stress is getting your car to the garage, as opposed to the knock-on effects that the cost might have. But I like the idea of having like a bit of a standing order to a separate kind of car bank account. Um,
Yeah, I call it the fleet fund.
nice. That's a good way of a good name. But yeah, I think it's just yeah, write the check every month and you know that you're stress free. So I think I'm
Yeah.
a great advocate of that.
Yeah, I've done it ever since I've had a car, which was actually my mum's advice at that time. She was like, put a bit of money away each time, each month for your MOT. It always comes around. You know when it is, you know when your
Yep.
tax bill is, you know when your insurance bill is. And I actually have lined all of those up. So I have them all within the same month. So I can just deal with most of the car stuff at once. And I can hopefully forget about it for another year. And just having a little bit of money put aside each month, I think I put like 100 and something, £120 away each month. That covers mine and my wife's car. And it seems to cover all the bills that they kind of spit at us. So I'm a huge advocate of that.
Yeah, that is yeah, nice idea. We do something similar. We have like like what we call the float. So that each of us puts a certain amount of money in each month, and it covers council tax, yeah, the car insurance, life insurance, all the kind of utility costs and stuff like that. So yeah, similar premise.
Yeah. Yeah, it's just again, it's just a stress reliever, isn't it? And you can get on about your day and your life knowing that actually those things are taken care of because you've planned for
Yes,
it.
absolutely.
Yeah. Yeah.
Perfect.
Okay. I'll be honest here. I don't know anything really about dividend investing. I sort of know how they work, but if you asked me to tell you, it would be a very short conversation. So I'm going to leave the kind of explanation to you, and I'll just jump in with any questions if that's all right.
Yeah, absolutely. And it's yeah, I'm hopefully can explain this in a way that is understandable. And I guess so to start with, what I was thinking is if I'll just explain kind of quite high level what a company that how dividends come about and how they're paid, and then also some of the key ratios that we look at when you're looking to invest in dividend paying shares, and then some of the behaviors that you should adopt when you get your dividends. And I guess dividends are more, you might hear them for like your like granddad or your an old uncle might have them, and they have these dividend paying shares that give them a bit of income every year. But dividends are actually a really important part of investment growth over a long term. So, and hopefully that will all become clear over the next few minutes. But I guess to start with, so business um, goes about its business and operations, and it makes profit, and then it has options with what to do with that profit. So often they will have to reinvest in the business itself. So there'll be things that they'll have to invest in, whether that like called capital expenditure or capex. So this is things if they've got like plant and machinery or like upgrading computers or getting the keeping servers running and investing in the latest technology to almost keep the business operating as is. They can also make like, have the option to invest in further growing that business. So they might want to invest in whether it be a new product line or investing in a new market or investing in a new division, something like that. So you can kind of have that's an option. They can pay off some of their debts if they have that, and there'll be an element of with debt they have to pay it off you have to pay your interest every year on borrowings, or you could have the option of paying off some of the debt that you borrow, as well as they have the option to return some excess profit to their shareholders, and that comes in the form of a dividend. And so a company is not obliged to pay a dividend, and often the companies that pay dividends are fairly established. They've kind of grown to a reasonable size. So every year there is excess profit that's available to get paid out as. And you'll see the dividend quoted is as like a pence per share or pounds per share perhaps. So if you often see something like, company pays 5p dividend per share. So every share that you hold, you will be entitled to that dividend. So if you had 1,000 shares of a company and they paid 10 pence per share, you would get £100 of yeah, £100 dividend. Companies usually split the dividend into two. So there'll be sometimes they call it an interim and then a final dividend. The interim is usually partway through the year, so like 6 months. Sometimes companies pay quarterly, but they're kind of few and far between. And then the final dividend. So the interim is usually smaller than the final, but then and what you're looking for is companies that will be increasing their dividend payments every year, which is a really good sign. Um, and often the companies don't want to be once they've declared dividends and declared a policy, they're very reluctant to renege on that because it can be very detrimental to the share price. So the companies that we hold within like ETFs and index funds, so they will be generating dividends. Quite likely you won't be seeing them a lot of index funds will have kind of an accumulation method of reinvesting dividends automatically, so you won't actually see the dividend. And others, if you can have an option of like an income, so that will actually then pay the money into your bank account or into your investment account. So that's kind of yeah. So hopefully companies generate profits, they pay some excess profit out, and some of the key things to look out for are so you'll have your dividend per share, but you'll also see something called a dividend yield. And this is, I guess, akin to an interest rate that you would see on a bank account, is the way to interpret it. So if you say had a company's share price was £1 and it declared a dividend of 5 pence per share, that would call the dividend yield would be 5%. 5%, incidentally, is actually a pretty solid dividend yield. I guess for context, the average dividend yield across all global markets is around about 1.6%, 1.7%. The dividend yield across the FTSE 100, I think, is around 3.5%, 4% historically. Um, just mainly because a lot of the companies in, say, the US, which dominates the global market, are quite young tech companies. And rather than paying out cash to investors, they reinvest that money into their own company. Whereas in the UK, we've got some quite more established big businesses, a lot of banks, big utility, like mining companies and BP, Shell, companies like that are listed in the UK, and they tend to pay a lot higher dividends. They're a much more established business. There's not a lot of room to grow, and therefore they distribute more excess profit to shareholders.
I have a question, if I may.
Yeah,
That
absolutely.
that kind of makes a lot. That makes a lot of sense to me. And I've obviously I've muted myself while you've been talking. I've been scribbling kind of questions. So you say like 5% will be a solid kind of dividend yield, um, and like the main question I have is how do you find like a good dividend paying company? Because I gather you can find companies that pay regular dividends at a good rate, but won't those be really popular? Like, how do you find what would be a good dividend paying company, like a good investment for your money, where or and to avoid like a poorly paying dividend? What kind of metrics would you look for?
Yeah, that's a really good question. Um, so dividend yield is a good place to start. So the share price is, um, so even though they might be popular, the dividend will still be paid out, and it would only, I guess, if you own the shares and the company became really popular and the share price rose because so many people are buying the shares, you would benefit from having a higher share price, but then the dividend would still you would still get the price paid on each of the dividends.
Right. So hold on one sec. So you can, sorry to interrupt you, but
No, no,
say
absolutely.
say you buy some shares in a company that pays a dividend, right? And you buy them for
Yep,
£100 each or whatever.
yep.
Then that share price goes up to, say, for example, £200 per share. You benefit by that growth as well as a dividend payment?
Yes, correct. Yeah.
Ah,
So you get so the return of an investment in the stock market is twofold. One is the capital growth. So yeah, the price goes up, but also dividends go up. Oh, you also get a dividend. Um, there's some time. So I guess to your question of how do you find a good company, you want a company that it generates profit, so it's profitable. It generates a lot of cash, and it's able. And if you look at the dividend it has in place, it's been growing that dividend regularly. And there are some companies, I always get the terms wrong, but there's what they call like the dividend aristocrats who have been paying dividend. They've increased their dividend payouts for the last 25 or 50 years. And
wow.
then there's so it's stuff like I think like Procter and Gamble, I think, is on there, and
Right.
um,
So like top tier companies that have just done
these are
really well for
really
a long time.
exactly. So they're really well established, but you're then not going to get, you know, your share price won't triple over the next 2 years in Procter and
Sure.
Gamble.
Yeah, yeah.
If you're Nvidia, that's obviously that happened, but they don't pay dividends. so it's a kind of carve out of the investment world is much more established, slower growth companies, but they're giving you dividends. So
Hmm.
one, you want to look for a company that's profitable, it's generating a lot of cash, and it's paying dividends out and it's growing those dividends. Another key metric is what they call dividend cover. So for every year, so you when you have a share at the end of the financial year, a company announces its financial results, and the profit it makes will be stated in a kind of per share metric called earnings per share, or you might see it as EPS. And so that's saying for every share I have, I've earned, it could be 20 pence of profit or earnings, which is then distributable to your investors. If you have a earnings per share of 20p and your dividend is 10p, you can cover that dividend by 2 times. So that's really healthy in that you are not kind of dipping into company reserves or having to borrow money to pay your dividend, which sometimes does happen.
Right. So you can easily afford it without getting the money from somewhere else.
Correct. Yeah. So,
Right. Okay.
so that's quite a nice a way of looking. Yeah, that's a good kind of acid test. And sometimes you can have companies that they could have a bad year of earnings and still pay out a dividend and have less dividend cover than one. So say you could have had earnings at 8 pence, but you're paying out 10p per share. Um, the board would only do that if they thought in subsequent years they're going to be able to make more earnings to kind of make up for the shortfall of that year's dividend payment.
Yeah. So they would have to then, in this example, get the 2 pence from somewhere else, but they
Correct.
might do that if they foresee good growth for the next couple of years to
That
make up for the loss.
exactly. Yeah.
Mm.
And
Okay. And just one other thing.
yeah,
Can
yeah.
you see the history of dividend prices for each company that you look at?
You can, yeah. So often I don't the best sources are either the best source will be on the company's website, so they will have an investor section and it will show you dividend payments, or services like Yahoo or like Morningstar, you'll be able to see the dividend payouts.
Right. So
And
it's readily available.
it is, yeah. And it can be quite yeah, it can be quite interesting to look at across different companies' dividend history. I think where you get dividend yields quite high, so 7, 8, 9% in some cases, often they're high because and the reason they're high is because the share price is low, and usually it's because there's some uncertainty about the future of that dividend payment and being able to keep that up. And or it could be that the company might be going into loss-making positions, or some bit of news has come out, or a bit of regulation has come out that means it's depressed the share price. So where the yield is really high, it's you probably have to be really cautious, um, and go in like kind of eyes wide
Yeah.
open.
So there's more risk involved.
Exactly. But if you've got a yields of
Yeah.
around 3.5, 4% and a good payout ratios, sorry, a good dividend cover, um, then yeah, that's kind of the nice company that
Hmm.
you want to be. You can be fairly rely quite solidly on that dividend.
Yeah. So those are signs of like a healthy company that would be a good place to park some money in order to get dividends back out. And I'm just thinking that in terms of like the financial independence movement, if you have enough invested to cover your expenses, could you then um, invest in dividend paying stocks and make sure at some point in the future, if your dividend payments you got were enough to cover your expenses, that would be a different way around of achieving financial independence.
Yeah, absolutely. So I think the way to look at it is you probably want the engine of like high growth companies to kind of start building wealth. But I guess once your portfolio is has grown, you dividend shares because they tend to be, I'm speaking generally, tend to be quite established companies, very
Mhm.
predictable businesses with big market shares. They tend not to, the share prices don't tend to be as volatile as some of the other kind of say the big tech or growth companies. but so that you won't get as much growth. But at that point, you probably don't need as much, so you can kind of pivot away to a bit more dividend investing and invest in companies that pay a bit more dividend. But yeah, in theory, you then can just live off the dividends that the company pays um, to cover your day-to-day expenses. So,
Yeah. I thought
and
that makes
it's
sense. I mean, I was just thinking earlier, you said about like Procter and Gamble, they've been around a long, long time. And I just had a quick Google that actually P&G or Procter and
mhm,
Gamble, they own 80 other companies. So
yes,
actually that's a really well established like overarching company. They aren't going to disappear overnight. And if you look, say, in a supermarket at a lot of the products there, in terms of probably the not food products, but the other stuff like shampoo, shower gel, deodorant, etc., a lot of them I found do come from like Procter and Gamble. Um,
yeah, it's
so
incredible. Yeah,
that would be, for example, an example of a good company to perhaps look at a dividend to get a dividend from. If they offer them, I don't know. Of course, do your own research. It's dangerous, etc., etc.
yeah, yeah,
But it would be like an idea of having a big overarching company that could fund part of that for you. It might be quite interesting to do it or part of it that way and to think actually I own enough dividends in X company, so now my water bill is free or my internet is being paid for by that company or however much money you get back from them, it then funds directly funds your lifestyle.
yeah. I, that's it. It's a good way of looking at it. And I think it's dividend investing is very, you know, you can. There's certainly funds out there that invest in higher yielding companies, and having some exposure to that, I think, could definitely be a good way of also diversifying. But it's probably, yeah, it's definitely an option, and certainly something I'll be looking at, um, hopefully in the not too distant future. But I, I think the other thing I just wanted to also add with dividends is certainly kind of pre-retirement. You want to be once you get that dividend, you'll have cash in your account, and you can do what you want with that cash. So you could go out and spend it, or you could go and reinvest it. And I've got some interesting figures to kind of demonstrate the importance of reinvesting some of those dividends. So this is more in the growth of your investments. So you're trying to grow your portfolio as much as you can to get to that point where you can then start harvesting some of that dividend income. And so I've got a couple of facts. So this was um, to, a fact around. So if you were to put £100 a month into the FTSE All Share, and that was a 30-year period from like 1973 to 2003, the 30-year period. And if you didn't reinvest your dividends, so if you just took the cash, you'd have at the end of 30 years, just call it just under £71,000 of your, that's what your portfolio would be worth. But if you took if you took your dividends and then reinvested them, that portfolio is worth 100 just £140,585. So it's kind of double the amount by keeping in the dividends. And then a really long-term horizon is so this is based in the US stock market. If you to invest, it was $1,000 in 1871, and you ran that to 2003, and if you just took the growth would be worth at the end of it, you would have $243,000 if you didn't reinvest any dividends, and if you just took the cash, or if you did reinvest your dividends, you'd have £7,947,930. So obviously that's more than a lifetime's worth of investing. It's more of an exaggeration to prove a point, but
Yeah, I think yeah, shame we weren't putting thousands of pounds in 1871. But I just have a
yeah,
question around both of those things. So, say take the first example. So the £100 per month into the FTSE All Share
yeah,
for 30 years, 73 to 2003. With no reinvesting of dividends, you get 71,000, and that is £100 every month, and it's like stock, like the value of each share growing
correct.
over that time. Yeah,
Yeah.
but do you get paid dividends at that point? So you get some cash given to you as well.
Yes. So I guess you would have. the dividends paid out to you. But
Yeah, so
what
you
you
get some cash flow.
correct. But what you haven't done is then reinvest that
Right.
back into the shares.
Okay. And then say for in that same example, so say you do reinvest all of your dividend payments and it's basically like upping your monthly contribution to an index fund, perhaps in a simplistic term.
Yeah,
Um, when you reach kind of that portfolio value at 140, I imagine that. Oh, no, actually, oh, I've made myself sound stupid because I was going to say, would the dividend payment be higher with £140,000 worth of stock? And of course, it would, right?
it would be compared to if you didn't
Yeah.
reinvest, because what you're doing with you're taking like the free money in inverted commas from your
Hmm.
dividends and buying more shares of the thing that has paid you more dividends. So if you were to, yeah, I'm just trying to think of an example quickly off the top of my head, but if you get a dividend of, that example of you got 1,000 shares and they pay you 10p a share, and that's each worth 1,000. Each share is worth £1, so you'd have got £100 of dividends. If you then reinvest it, you can then buy another 100 shares in that company.
All paying a dividend.
Yeah, and then the next year you'll have 1,100 shares paying you hopefully a slightly bigger dividend, and you do that then over a couple of decades, and it becomes very powerful. It's like fuel to the compounding
Yeah, or
machine.
sales, extra sails or rowers to the boat
Exactly right.
analogy from last time. Yeah. So
Yeah.
it's another form of momentum, isn't it? Basically, in terms of allowing your money to work for you. It's still working for you. It's just done in a slightly different way.
Exactly. And even when I know we advocate for just buying index funds and you buy the market, that you will still be generating dividends income from that. They'll just be lower than if you were to, I guess the approach to dividend investing is you're actively seeking out companies that are paying higher dividends, but because they tend to be more established, their longer term growth prospects aren't as big as
Hmm.
kind of the wider kind of growth market. So it's it'd be more purposeful in choosing those specific companies or those funds which are investing in those dividend in kind of dividend paying companies with a view then to paying a good income. But it does, I've got a few dividend paying shares, and I love seeing my dividends roll in. Um,
And are they paid monthly, just into your current account or wherever you're making the investments?
It goes, yes, it goes into my ISA. The dates, they're not a monthly thing. They tend to be either every 6 months or every 12 months. Um,
Okay.
and the dates vary. So it's usually like March, April tends to be a good time. September, December seems to be good.
Does it differ depending on the
Um,
company you buy?
it does, yes.
Right. Okay.
So what they will do is it will be then linked to their financial calendar. So they will announce when you're a publicly listed company, you have to announce your financial results every 3 months. The 6 month is like the half year, and that's the interim. If you're paying an interim dividend, that's when you declare the dividend and pay it, and then also at the
Sure.
full year at the 12 months. But because it takes a few months, it takes like a month to 6 weeks to kind of calculate your financial statements and your profit and loss for the last kind of previous quarter. It kind of say if you had your financial results, Amazon's a good example. We've finished our financial year at 31st of December, and we will announce our results, I think, end of January. So it takes there's a month lag. So it's not like you would kind of hear the results the day of the 30th of or 31st of December.
Yeah, it takes a bit of time to do some number crunching, etc. But
Exactly right.
just a quick thought experiment. So if someone so to me, the dividend investing is a little bit more hands-on. You get a bit more choice in there. It's a little bit more
Mhm.
like you're actively managing your own portfolio rather than the kind of invest and sit and look out the window thing that we've talked
Yes.
about. So it might kind of scratch an itch for someone who wants to try like stock picking. You could try like some dividend stock picks and something like that and see how it goes. Could is it do you think it's possible, or maybe, I don't know, to buy a dividend paying company for every month of the year? And if they are all kind of solid, healthy companies, you could then potentially have a dividend payment on almost a monthly basis.
Yeah, there's definitely ways of doing it. I think you might have to cross between the UK and US markets, maybe. But yeah, there's definitely
Hmm,
be a way of doing that. But I guess the priority would be picking the companies rather than
sure.
when they're paying the dividends out. But yeah, it's definitely doable. Um,
Yeah, of course. I mean, I'm
yeah,
sure that there are loads of people around YouTube, etc., and kind of Reddit boards that purely do dividend investing, and it's just their whole bag, and that's all they do. So, I would encourage anyone listening, if they want more info, just to watch a couple of the YouTube videos around it, and just go in with an open mind. But I feel like it kind of would scratch an itch for me about picking things and kind of seeing how you'd navigate that with perhaps less risk. I mean, the risk, I guess, is not getting as good a returns as you could elsewhere. But I feel like if the company's really established, you could always sell those shares for an amount, and recoup some of the kind of capital you've put in, and it could be a good thing to do as in addition to kind of the standard index and chill thing that we suggest as well. So that's really interesting. I feel like I know a lot more about dividend investing now. I think you explained it very clearly, and I've kind of pitched in with some questions and stuff. But do you have anything else around dividend investing? Is it something that you're going to continue to do? Do you think the closer you get to your kind of financial independence target number, will you do more dividend investing or less?
yeah, I think I'll continue to do more. I mean, I really like it, and I guess my portfolio, the way I structure it is I kind of have a core like it's like 90% of all my money is in really broad-based index funds, and then I have a kind of bit of play money in what I call like my satellite portfolio. So that's I say not play money, it's still a fair chunk, but that's in companies I like to research and invest in, and they tend to be kind of like value investments. So they're a bit of beaten up. Some of them pay decent dividends, and I like, you know, researching them, being a shareholder, and being part of a bit like feel like a business owner of those, and I would like look out for the financial results and read the annual reports. So I quite like that, but it's not most of my money is still in global index funds
Mm.
that has a quite low yield. But yeah, as I get closer, once I've kind of built up that critical mass, it'll be a shift for me to a bit more income from dividends.
Yeah, because you've got a safety net for sure, and I can see really how that would appeal to the analytical planning part of the spreadsheet part of your brain.
Oh yeah, I find it. Yeah, I really like it.
Yeah, I thought you might. I
Yeah.
thought you might. Okay, shall we play a quick game of reasonable or ridiculous,
Yes.
of which I have a topic for
Oh,
you.
excellent.
So say like I don't know, you work wherever you work and your employer wants to send you on a training thing somewhere and it's quite a distance away and you've got the choice of either driving or the train. So the journey is going to take you somewhere between 90 minutes and 2 hours each way. Can be a little bit problematic, traffic, etc., weather, crashes, etc. Do you think it's reasonable, and assuming as well your employer will refund your travel expenses only, so to and from mileage or train tickets up to an amount? Do you think it's reasonable or ridiculous to book yourself a hotel close to wherever you're doing the training and are just paying that out of your own pocket? So you feel a bit more refreshed. You don't have so much of a commute, um, so you can really take in more of that training. Or is that a ridiculous waste of money?
Yeah, that's an interesting one because I think, a couple of hour train drive to and from is not very pleasant. And but I think, yeah, I would say it's fairly reasonable to get a hotel. I think you want to go to the course and be refreshed and take it in. And I think are you going to be able to get the value from the course if you're tired or if you've had a stressful journey? And I don't know about you, but my view, I feel everybody has suddenly got really bad at driving. There seems to be roadworks absolutely everywhere, and it's so hard to get anywhere in any form of transport now. I don't know what seems to have happened to British society, but I think it's very reasonable to get something the night before and make sure that you turn up refreshed and ready to go because I think you'd get more out of the course in the long term.
Yeah, I think I would agree, and I have started doing this just because so I'm not so tired and I don't have to put so many hours in driving. And how I work this out is I'm like, obviously, I'm not staying at like the Savoy or the Dorchester or some high up fancy hotel or whatever. I'm getting like a basic Airbnb travel lodge type level, but kind of you're at where you're at, pay what you're happy with. But the way I work this out is I take my hourly rate from work, like my true hourly rate, as we've discussed before, of working that out, and then work out how many hours it will take me to do the journey. And then I'll get a figure like it'll be somewhere between this many hours. And if there's traffic or delays, I'll add an extra hour for that, especially around the M25 or the Dartford Bridge or tunnel or something. And then I
Yes.
see actually, can I get a hotel within walking distance for less than that would cost? If I can, then I do it. And if I can't, I'll kind of tweak it. I'll add like some extra benefit in terms of being less tired. And if I really can't do it, then I'll do the driving and the journey, and just see how I can make that as least kind of arduous as possible with like a train or something. But if you'd asked me this question 6, 7 years ago, I wouldn't have done it. I'd have driven every day. But now,
Mm.
as I get kind of a bit older, and more wiser around financial kind of decisions, I look at different value and cost in different eyes, different lens. So I've booked myself an Airbnb next to a hospital here for a training day I'm doing in March, and I'll probably report back at that time how that went and whether I think it was worth it or not.
Yeah, that's a good one. And I think that's yeah, infinitely sensible.
Yeah,
Um, and because I mean I've been on similar situations where I've been on training and had a long drive beforehand, and I'd done the journey there and back. But then it's the knock-on effect of the following day
yeah,
as well to then recover. And yeah, I think it's I think it's sensible.
yeah.
So yeah, I would say reasonable is my
Yeah,
verdict.
agreed. You'd also save yourself a bit of fuel, wouldn't you, in between? Okay, so I'm going to have a quick go at summarizing uh, stuff. So, in this episode, we've talked about how breakdown insurance is very useful if you are a car owner, and being in a good financial position removes a lot of stress. We've talked about the kind of the main bit of the show, dividend investing, and for my new kind of knowledge about dividend investing, Alex, from you, it's when well-established companies do well, they're healthy, they have excess money, and they offer dividend payments to shareholders. They can be either kind of annual, 6 monthly with an interim payment. 5% is a solid dividend yield, and just have a look at it. Look at other websites, look at company websites, Morningstar as well. Look at the history of dividend prices, and if you're well on the way to fire in the boring middle section, and you want to use a little bit of your kind of portfolio, a bit of your cash to have a look into dividend investing, we'd say that that would be the time to do it. And we both agree that it's reasonable to pay for a hotel if you're going a long way to travel, because there's a sleepy element to it and also a cost saving in journeying. But really, if you have like good financial behaviors, use that to your advantage. I promise you'll probably sleep a lot better if you kind of get a hotel, you don't have to do all the driving and it takes a bit of stress off of you. And really, that's what Alex and I would argue money is for. It's a tool to make your life easier and better, not something to hoard like the dragon out of Lord of the Rings.
Yeah, I think that's a really nice summary. I like that addition.
Cool. Let's continue it in all going episodes. But yeah, if anyone has any questions for Alex about dividends, anything else you want to bring to us, you want to come on the show and talk to us about a particular topic, or you have any ideas of topics you want us to cover, you can email us at nursingyourwaytowealth@gmail.com. And with that, it's been 41 and a half minutes. I'll thank you for your time, Alex, and your expertise. Thank you to those that are listening, and we'll see you next week.
Yeah, see you later, everyone. Thanks, Alex.
None of what we discuss on the show is to be considered financial or health advice, and we recommend you always do your own research or consult an independent financial advisor or a doctor when making your financial or health decisions.